Warren Buffett, the renowned investor often called the Oracle of Omaha, is celebrated for his extraordinary success in finance. His company, Berkshire Hathaway, stands as a testament to his investment acumen. Buffett's approach emphasizes prudence and a deep aversion to unnecessary risk. His track record speaks for itself. Over the decades, he has earned the trust and admiration of millions of investors worldwide. Buffett's approach to risk management diverges significantly from other financial institutions. While many firms rely on sophisticated models and algorithms, Buffett takes a more pragmatic, experience-based approach. He criticizes the over-reliance on models using standard deviation as a risk measure. Such models often fail to capture the true complexities of financial markets. Unforeseen events or black swan events can significantly impact investments. Buffett emphasizes thorough analysis, sound judgment, and understanding businesses. He stresses the need for a margin of safety, investing below intrinsic value. Buffett's approach underscores long-term perspective, patience, and stability. One of the hallmarks of Warren Buffett's investment philosophy is his emphasis on maintaining a substantial cash reserve. Unlike many companies, Buffett views cash as a critical safety net and a source of opportunity during market turmoil. He famously quipped, "Cash is to a business as oxygen is to a person." Holding significant cash reserves provides flexibility to seize attractive investment opportunities during periods of market distress. Warren Buffett harbors a deep skepticism toward relying solely on statistical probabilities and mathematical models to determine financial safety. He is particularly wary of approaches that emphasize precise numerical calculations, recognizing the inherent limitations of such models in capturing the complexities and uncertainties of the real world. Buffett's skepticism stems from his understanding that financial markets are not always rational, and are prone to unpredictable events that defy even the most sophisticated statistical models. He emphasizes that relying too heavily on these models can create a false sense of security, leading to complacency and an underestimation of potential risks. This skepticism is rooted in his belief that human behavior, which plays a significant role in market dynamics, cannot be accurately predicted or quantified by mathematical formulas. He cautions against the allure of precision, arguing that it can give a false impression of control and lead to a disregard for the potential for unforeseen events. Embracing uncertainty is a fundamental aspect of Warren Buffett's investment philosophy. He acknowledges that uncertainty is an inherent part of investing. Instead of seeking absolute certainty, Buffett focuses on managing controllable risks. He stresses the importance of a margin of safety in investment decisions. This involves buying assets at a discount to their intrinsic value. The margin of safety acts as a buffer against unforeseen events. Buffett's philosophy underscores humility and the limitations of forecasting. By focusing on controllable factors, investors can increase their chances of long-term success. While many investors seek optimistic projections, Warren Buffett and Charlie Munger focus on worst-case scenarios. They believe understanding the worst outcomes leads to better decisions. Conventional risk management often overlooks catastrophic events. Buffett and Munger's approach ensures comprehensive risk assessment. They analyze worst-case scenarios to identify vulnerabilities. This helps them decide if potential risks are acceptable. Central to Buffett and Munger's strategy is the margin of safety, a principle from their mentor, Benjamin Graham. It involves investing in assets trading below intrinsic value, acting as a financial fortress, protecting against market downturns. By buying below intrinsic value, investors create a cushion for potential shocks. This approach emphasizes not overpaying for assets, even high-quality ones. Section 3. The perils of overconfidence. Buffett and Munger caution against overconfidence in investing, where false security can lead to disaster. Overconfidence often stems from over-reliance on models and ignoring market uncertainties. They've seen the impact of overconfidence where belief in one's abilities led to significant losses. Buffett emphasizes the market is a voting machine driven by emotions and short-term sentiment. The allure of high odds. Finance often presents lucrative opportunities with high odds of success. Investors are enticed by ventures promising substantial returns with minimal risk. Warren Buffett and Charlie Munger caution against this allure, emphasizing that even small risks can have significant consequences. They avoid unnecessary risks, understanding that calculated odds can be disrupted by unforeseen events. They emphasize weighing potential downside against potential upside. Section 2. Protecting the downside. Buffett and Munger emphasize protecting the downside. Their principle, don't lose money, prioritizes capital preservation. Losses have an exponential impact, making recovery harder. This contrasts with high-risk strategies focused on maximizing returns. Such strategies can lead to catastrophic losses, wiping out gains. Buffett and Munger prioritize businesses with strong competitive advantages. They seek financially stable companies, capable of withstanding downturns. Section 3. Playing the long game. Buffett and Munger focus on long-term investments, ignoring short-term market fluctuations. They identify undervalued assets for sustainable returns over decades. Their patience and discipline help them avoid impulsive decisions. They believe the market will eventually reward businesses that generate value. Section 1. The limits of Sigma. Warren Buffett criticizes Sigma-based risk models for oversimplifying financial complexities. He argues these models overlook catastrophic events outside normal statistical expectations. Extreme events, or black swan events, are more likely than Sigma-based models predict. Markets often experience irrational exuberance and panic, leading to extreme price movements. Buffett calls for a nuanced approach to risk management beyond just statistical models. Section 2. The illusion of control. Buffett argues that statistical risk models create a false sense of security. These models often fail to account for human behavior and market complexities. This overconfidence can lead to excessive risk-taking. When models fail, the consequences can be severe. Even sophisticated models are only as good as their assumptions. Flawed assumptions lead to flawed outputs. True risk management requires understanding businesses and skepticism. Buffett reminds us that models are tools, not oracles. Investors need to acknowledge the limitations of quantitative models. Section 3. When models fail. Buffett's skepticism is rooted in real-world failures of risk models. He cites examples of significant losses due to flawed models. Models often underestimate extreme events. They assume past behavior predicts future outcomes. Black swan events catch models off guard. Overly complex models mask their fragility. More assumptions mean more potential errors. Simpler, transparent approaches are needed. Buffett advocates for common sense over complex formulas. His observations highlight the need for practical risk management. Section 4. The need for humility. Buffett calls for humility in using statistical models. Models are useful but not infallible. Investors should be skeptical and aware of potential errors. A balanced approach combines quantitative and qualitative analysis. Consider a wide range of outcomes, including improbable ones. Markets are not always rational, unforeseen events occur. Today's complex world requires sound judgment. True risk management goes beyond numbers and algorithms. Buffett's insights remind us of the limits of our knowledge. Section 1. Echoes of the past. Buffett believes in learning from financial history. Studying past market cycles provides valuable insights. Human emotions of fear and greed remain constant. Historical market panics offer lessons for today. Understanding past mistakes helps navigate present challenges. The past offers wisdom to avoid repeating errors. Warren Buffett often recounts the Northern Pacific Panic of 1901. This event highlights market irrationality and the dangers of excessive speculation. A battle for control of the Northern Pacific Railway spiraled into a market crisis. Rival investors drove the stock price to astronomical levels. When the price became unsustainable, a wave of selling ensued. Margin calls forced liquidations, spreading panic to other sectors. The Northern Pacific Panic is a cautionary tale about excessive leverage and market contagion. Warren Buffett critiques statistical risk models that rely heavily on standard errors and probabilities. He argues these models often fail to account for rare but high-impact events. History shows the limitations of relying solely on statistical probabilities. Many market crashes occurred when risk models suggested they were improbable. This highlights the limitations of using past data to predict future events. The Northern Pacific Panic underscores Buffett's key tenet: margin of safety. Investing in assets at a discount provides a buffer against unforeseen events. A brewer's suicide during the 1901 crash highlights the dangers of overconfidence. Maintaining a margin for error is crucial in financial affairs. Warren Buffett and Charlie Munger's approach to risk management extends beyond simple calculations. They build multiple layers of safety, prioritizing capital preservation and long-term stability. This cautious approach is rooted in understanding market uncertainties and potential disruptions. They focus on businesses with strong competitive advantages and consistent earnings. Diversification acts as a shock absorber. protecting against unforeseen events. Section 2. Stewardship and Responsibility. Warren Buffett and Charlie Munger's philosophy on risk management is deeply intertwined with their sense of responsibility to Berkshire Hathaway's shareholders. With hundreds of thousands of individuals and families entrusting their savings to the company, Buffett and Munger feel a profound obligation to protect and grow their capital responsibly. This sense of stewardship guides their investment decisions and shapes their cautious approach to risk. They view their role not merely as investors, but as stewards of other people's money. This perspective instills a sense of caution and a long-term orientation in their decision-making. They are acutely aware that a single misstep or miscalculation could have significant repercussions for their shareholders, many of whom rely on their Berkshire Hathaway investments for their financial well-being. This sense of responsibility extends beyond financial returns. Buffett and Munger recognize the importance of ethical and sustainable business practices, seeking out companies that operate with integrity and a commitment to creating long-term value for all stakeholders. Their approach to risk management, therefore, encompasses not only financial prudence but also a commitment to ethical and responsible business practices. Section 3. Navigating uncharted waters. Buffett and Munger's risk management emphasizes preparedness and adaptability. They maintain a significant cash cushion for flexibility during market distress. This ensures Berkshire Hathaway can capitalize on opportunities when others retrench. The essence of prudent stewardship. Buffett and Munger's approach to risk management isn't about eliminating risk. It's about understanding risks and ensuring rewards justify potential downsides. Their philosophy is rooted in long-term perspective and thorough analysis. They advocate for a margin of safety in all investment decisions. Their preference for cash reserves provides flexibility during market dislocations. This prudent approach has allowed them to navigate decades of market cycles. Section 2. A Legacy of Wisdom. The enduring legacy of Warren Buffett and Charlie Munger extends far beyond their financial success. Their insights into risk management offer invaluable lessons for making sound decisions. Their philosophy, rooted in common sense and intellectual honesty, provides a timeless compass. They remind us that true risk management is about embracing uncertainty. Their approach urges us to question conventional wisdom and think critically. Their legacy is a testament to patience, discipline, and a long-term perspective.